Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlotnick, and it is my pleasure and a privilege to welcome back my really good friend, Chad Ackerman.
Good to see you again.
Great to see you too. Chad, he's done many things. One of them, obviously, founding or co-founding Leftfield Investors. And then since Leftfield was acquired by the Passive Pockets, Bigger Pockets, now it's called Passive Pockets. And then Chad is still is affiliated with them at the same time. He's also a coach with Focal Point. So welcome back to the show.
Thank you. Yeah, I've got a laundry list in my past of things that I'm involved in, that's for sure, but never want to be bored.
Well, it's again, I don't know the whole history from the beginning of time. I just know that the Leftfield was an interesting adventure, and you started with a platform that many passive investors needed to get the right education. And now you're doing coaching. So before it was just an educational platform, networking platform for investors to meet sponsors and to be able to do some collective due diligence, and now it's coaching, because it's hard. A lot of people need coaching, and I guess you're coaching both the investors and the sponsors.
Absolutely. Anybody that's running a business and investing is business. A lot of times limited partners have their own business as well. Operators obviously are running a business. The materials of Focal Point allowed me to blend with my experience of being in the industry running Leftfield for so long. I think it brings some value back to the community. And that was my goal, is to give back to the limited partner investors that were part of Leftfield and part of our community, now part of Passive Pockets, but also to help operators that were, you're engaged in the middle of the process yourself. There are people that are starting out as operators that are maybe done it for a year or two that maybe don't understand the business side as much. And so I like the tools that Focal Point developed me with, or gave me background on, to be able to bring that to those operators and help them kind of get their business structure set up correctly, let alone worrying about good deals and underwriting and LPs and everything else. So I thought it was a good way for me to go back and help out. With all the experience I gained at Leftfield with working with limited partners, there was a lot of investor relations kind of assistance I think that I could bring to operators as well, just because we ran a community of LPs for so long. We heard what they wanted. We heard what they were struggling with. So I think there's a lot of good advice I can kind of bring to the operator side of things as well. But I want to work with LPs still too, and help them with their business and the business of investing, help kind of educate them more. Leftfield was all about educating. Passive Pockets is still about educating. So I just found another avenue to bring that to the community members as well.
Yeah, and I appreciate that wisdom. And there are two big angles, and they're very different angles, although they kind of meet in the middle. So how do you, what we're recording this sort of middle of April, not quick, well, towards the middle of April 2025. Obviously, the environment is very different now than a few years ago. So in this environment, what are the hottest topics to the sponsors who need coaching? Obviously, smaller operators that are trying to navigate this very different landscape versus a few years ago, versus existing operators and existing sponsors. So what do you see? Because you have specific folks you're working with. And then on the other side, on the investor side, many investors have had their challenges with checks written a few years back because the market conditions shifted. Operators were not exactly ideal the way they thought they would be. And so how do you take folks on the other side of the spectrum through the experience, and how do they adjust on a forward basis? Because people can't go fix the past. They can only fix the future. And then the coaching work hopefully helps them with the future decisions and future investments.
Yeah, no, absolutely. On the sponsor side of things, I think what we learned that was the biggest piece of advice that we could give operators, especially newer operators, is help them understand this is a relationship business. Limited partners like to invest with people that they know, like, and trust. And that takes time to build that. And that's the structure we've built. Passive Pockets supports it as well, of giving different avenues for operators to be able to meet LPs in the community on a frequent basis so that they can build that trust and so forth. And so what I found with Focal Point is the ability to help them kind of guide them through strategies around building that trust. How do you get known? Well, go do webinars, go do lunch and learns, give free content, teach people about the industry, and build your own credibility by doing that. But also it's another touch point of, okay, I heard them do this. They said these things. That sounds good. I want to call them up and talk to them and get some more information from them and start that process. That's what we want to help newer operators understand, is it's not just show up and ask for a check and you're going to expect to get $1 million out of people. It doesn't work that way, especially in this environment where LPs have been burned over the last few years by operators that didn't set things up well. That know, like, and trust relationship is even more important now. So that, that's the big angle with the operator side of things, is just kind of help educate them of don't think this is a race. This is a marathon. It's not a sprint. I guess it is a race, but it's not a sprint. Take your time, be willing to put in the time to build that relationship, make yourself available so that the operators can really grow to trust you and know your process, your underwriting, your conservative approach, so that they can feel comfortable writing a check to you. That's a big part of it.
Have you seen adjustments to underwriting? And almost the answer is it must be, right? What the due diligence was a few years ago is now very different. Market conditions shifted so much, and the factors, the variables, the assumptions are very, very different. Are you coaching folks to look at different set of variables? It's obviously cap rates, interest rates, right? Some really basic stuff. The other set of questions that have come up with, and on both sides of the equation, operator capability to execute. So we've seen a lot of challenges with execution. Folks have taken on projects being 1,000 miles away and not being able to manage, then trying property manager remotely, not being able to manage, then taking things in-house. So some of these experiences have demonstrated that it's hard. And whatever the strategy, it's not easy to build that overnight.
Yeah.
So what people are doing different today to be able to execute well today versus a few years ago? It almost didn't matter how well you executed because the market kept solving all the problems.
I would say the market bailed everybody out. Yeah, 100%.
So these conversations are very relevant, and as part of coaching on both sides, how do you evaluate? You're talking to investors on the other side, right?
No.
How do you know somebody can actually execute today? And we've seen something really interesting. We've seen people a bit more than they can chew. People have run into issues where things were, COVID related, right? They couldn't execute evictions, etc. Then the rent projections didn't hold up. The new supply came in, and there's all kinds of variables that today need to be added to the equation when making investment decisions, even to come to the conclusion, is this a strong deal or not?
Yeah.
I'm just curious, any thoughts that you've seen from conversations on both sides of the spectrum, the sponsor conversations and then also investor conversations? How do they look at these, writing these fresh checks? What criteria, what changes? I'm engaged with another member of the community. I'm not going to mention this, but he does a lot of due diligence work. And these discussions are, it's an evolving, changing environment.
Absolutely. No, due diligence has always been important, but you're right. The market bailed out a lot of limited partners as well. They could be more passive. They didn't have to do as much due diligence if they didn't want to. And that promoted kind of some laziness from an LP standpoint. And we've always said, we phrase it as, you need to be an active passive investor. It's hard to be a truly passive investor in the space because you got to stay educated. Part of that is due diligence around, deal structure became so important, of understanding how mortgages were set up, how loans were structured, to see if the operators were being conservative enough and protected enough. Minimum rent requirements, information like that, that people probably weren't going to that detail in the PPMs a few years ago. Those things became very important to understand, always were, but they got a spotlight put on them over the last few years. So I still am a firm believer you can find deals in any environment, and this is a pretty tough environment still right now. But due diligence is your king here of going in and understanding, spending more time in that PPM than maybe you used to really understand where are the risks and do they align with your own risks on how they're approaching these deals nowadays. My other side of this, kind of the reverse of it, is I feel like there's no better time to be an LP than right now because a lot of these operators that were newer, that weren't really experienced, didn't understand the space, got exposed. And so there are fewer operators to really pay attention to. My suggestion usually is go find operators that survived these last few years and still had deals that, maybe they didn't even have to stop distributions if they structured well enough, or they stopped distributions for the right reason. Follow that track record through how they managed these last few years. But even better than that, find an operator that survived this environment and find an operator that made it through 2008, 2009 as well. That's a really seasoned operator that's been through the most trying financial situations we've been in the last 15 years. If they made it through all of that, that's a pretty good place to start anyway. Still do your due diligence, understand what they're doing, but those are operators that have a good track record that would be worth looking into.
Yeah, thanks, Chad. And I'll add this commentary. So in general, this is a sound process with a couple of sort of thoughts. One, not too many people were around 2008, just to be,
It's a small
relative to
lift.
yeah. So if you've been around this long, you've really been in business for a long time. I mean, we're talking
Yeah,
about, what is it, 17 years, right? So 17 years, and you survive that cycle means you had another however many years before. So you're talking about kind of old dogs of the industry, right?
agreed.
At this point. The other thing that I really struggle with today, sort of my own observation, and I'll tell you this, um, recency bias is just too strong. We all overreact to the recent events,
Yeah,
including some of the things that outside of our control, number one, and number two, the acting on recency bias would tell you keep buying stocks. Why the hell would you want to go into these discounted and distressed multifamily assets? Because
right.
you've done well in the stock market. Why change what has worked, right? But it's exactly the opposite now. Now we're recording this with heavy volatility in traditional markets, and alternatives like real estate, commercial real estate is trading. A lot of these assets are trading at a much better value.
Yeah,
So from that perspective, even looking at the sponsors who have been beaten up and they made mistakes, there's something to say about the book. Sometimes you win, sometimes you learn.
true.
Experience is what you get when you don't get what you want. There's a Russian old saying that says people give 7 inexperienced fighters for one that's been beaten down. Why? Because hopefully they've learned from their experience.
Yeah,
Right. So I kind of go back and I think about this. The industry is really looking for answers or for changes, but a lot of them is back to real basic fundamentals. One of the things that most of us missed is we adjusted to the days of investing in 21, 22, where if you don't take action, somebody else will, and you'll miss the boat.
yeah,
And market cycles were not really looked at that time. It looked like the market cycle would continue indefinitely. Most of investors were not full cycle investors. They were sort of all momentum investors. Now, when the pendulum swung all the way the other way, people are looking, well, definitely who survived, right? Who seems to have survived the downturn, and they have ability. These deals are not all fallen apart. So
Yeah.
there's some logic to that. But on the other side, what lessons have been learned? So I almost go back, and I don't know if you're using this in sort of in coaching, but one of the most useful tools in coaching is analyzing your own mistakes, then analyzing mistakes of others, and
Right.
then learning what lessons have you learned from that experience. I'm just curious if the coaching process has any of that
It,
thought.
it it does speak to that, and it's absolutely a thing. In this business, the tricky thing for me, just from advice that we gave to LPs as we went through, our one of our goals for LPs was don't be the guinea pig. Don't be somebody that's trying out something that the operator is doing that's different than they did before. And learning whether they learned from this market or not is kind of a guinea pig situation of you're taking that risk of, okay, you saw what went wrong. Are you managing it differently now? That's where you really got to dig into the due diligence and see if they're structuring their deals differently than they did 3 years ago when things went awry on them. So it's just go with caution. I'm with you. Hopefully, the biggest lessons we learn are from failures, not from succession or succeeding. So hopefully there's a lot of operators that come out of this licking their wounds, but learning something and pivoting. Just take extra caution. You saw that they failed with deals before. Make sure they've accounted for whatever they needed to adjust. And it's your comfort level, it's your risk level of what you would be okay with from an operator pivoting to. Just make sure you have your criteria, what you need. And, there's other deals around the corner. So don't be fearful that I've got to jump in this one. Take your time. Make sure you're getting it right for what your risk tolerances are.
And that makes sense. And I'll add one comment that sort of this conversation continues that's on my mind. So quite a, quite a lot of folks did exactly what they did before and they still completely failed. This is the crazy part.
Right.
So people did what worked and they continue to do it. And as an example, they did value add deal with floating rate debt.
Yeah.
And then they were turning them fast and the folks with high leverage on top of all that, right? And the folks that went into low leverage fixed rate debt, they're the folks who are surviving because they have the downside protection.
Yeah.
Now, if you look at the stuff today, and I have to say this, of course, we've seen a reset in the interest rate environment, so we don't know whether rates go up or down. But again, the risk of massive spikes of interest rates from now are, they're relatively small. It's just a
Right.
question, what cuts are coming and when. We're sort of stalled in this environment. But the point that I'm making is that the shift was so large and fundamental that you almost need sort of new applications of the standards. In other
Yeah.
words, do all variable floating rate mortgages are bad? If you categorically said no,
Yeah.
then which ones are good? And they are good on the deals that you actually are buying really, really well. And then you in the past, the reason people took floating rate mortgage, there's a primary reason. Just I'm using this as an example of a very industry standard thing that took place that backfired on a lot of people. And
Yeah.
now people are categorically, I just want fixed rate debt as an example, which is not necessarily bad at all, but there are drawbacks. You have prepayment penalties, right? If interest rates fall and you're locked into fixed rate debt, you can't refinance or exit without penalties. On the
Right.
other side, right? If you take floating rate debt today when the interest rates are high and the interest rates can fall, you have the optionality to refinance if you can actually execute the plan. I'm just saying that as part of the learning process, at least I go through, and I'd be curious to hear your thoughts. I try not to be categorical on anything,
Yeah.
especially
I agree.
if something broke, it used to work, and now the pendulum swings all the way. You just always got to lock in fixed rate debt, low leverage, go as conservative as you can, because it is not always the right answer on a forward basis. It's
Agreed.
just more of a lot of the point of lessons is to understand applications of each kind of approach and why it didn't work or failed or ran into problems, and when is it applicable again? Because the technique itself is not necessarily a bad technique. It's
Yeah.
just when the timing was terrible, then yeah, it malfunctioned terribly. This is
Okay.
one example related to the interest rates. The other
Yeah.
examples could be, in the operations or identification of location, etc. So, give me some thoughts. What else are you doing with LPs to give them fresh perspective and give them a little more confidence to take action? Because the other
Yeah.
thing that I see is people are gun shy today way more because they got burned. When you get burned, you have categorically, literally one of the biggest fears in the industry. And Jeremy Roll, he's a frequent
Yeah.
speaker. His biggest fear is a lot of people will walk away permanently from
Right.
alternatives because they got burned. And that's the danger of exactly this environment. So many people, I hear this, if I only was in a stock market, I got rid of my 401k, I converted that 401k and I took the money out of stocks and I put it into these multifamily deals. And look
Right.
where I am now. Some of these deals are in terrible shape. And this absolutely, it's a
Look at where
painful
they are
experience.
today if
But
they would have left their
they're
money in the
now
stock
can't
market.
wait to get out. And I don't know what they do, but they want to get out at the worst time and not look at the opportunities ahead.
Yeah. And look at where their stock would be today if they left it in, as bad as the market is downturned here over the weekend, for crying out loud. How do they feel about multifamily at this point then? No, I think it's right. LP, it's very interesting on the LP side because it's very situational. Everybody has different goals. Everybody's at a different point in their life that they can take different risks. They have different risk tolerances and so forth. So there isn't, to your point, there isn't a global answer. It is very situational to each LP of what they can jump into, what they can't. I think an area of the PPM that I didn't pay much attention to, that I pay more attention to now, is the stress tests. So understanding, okay, you're going in with a variable rate loan. I don't think that's necessarily bad all the time, like you're pointing out. If the market, if the interest rates are going to go down, then that variable rate is going to be helpful to you actually. But what is the risk tolerance that your deal structure can take if the rates do go up by 1%, 2%, just in case we have that again? Do you have that factored into your deal structure? And is it still going to produce money or at least not create a situation where you need to take capital on or hold distributions would be ideal? Just understanding that. And I think seeing that the operator is going through that mental calculation themselves with their pro forma helps me think better about the operator that, okay, you're thinking about the same worries that I have of variable rates, maybe not the worst thing in the world at this point in time, but what if? What if it does take a different turn? Obviously, there's a lot going on in the global economy these days that who knows what the impacts out of all these things will be before it's over with. But are you, stress testing your deal enough to allow some fluctuation that still, how soon before we're in trouble? Where is the real risk at? And, how comfortable then do I feel of reaching that point? And that my goal is with LPs is have them map out their goals, their criteria as best they can, so that when they go into deals, they can measure against those criteria and be willing to walk away if it doesn't meet your specific criteria you need. You're not going to be able to talk the operator into changing things for you unless you're Jeremy Roll. Jeremy does a good job of doing that sometimes, but beyond that, you need to be prepared to take the deal as it's presented in the pro forma. So if it doesn't meet your criteria, don't have the fear of missing out. There is another deal around the corner. There will be other deals that come in. So
So I'm
be
hearing,
patient.
I'm hearing you're teaching folks back to the basics. Know thyself, know your own
Exactly.
goals, right? And you know what's
Start there.
crazy? A lot of people didn't even have any goals. They
Yeah.
look
Yeah.
at bright and shiny objects. And are you investing for income? Are you investing for tax benefits? Are you investing for income and growth? What kind of distributable income do you need or do you want?
Yeah.
So all these are right questions. Time horizon, right?
Right.
Leverage, risk profile, and what is for going into the risk. And kind of everything you mentioned. The hilarious part is this. This is not hilarious. It's sad. Sometimes you could look at this and you can laugh. You can cry. You could laugh about it.
Right.
A lot of this information was available.
Yeah.
Sensitivity analysis was always available. You could ask a sponsor, if you ask him, have you done sensitivity analysis? And if they had no clue what it means, obviously they had no clue, right?
Then
And
walk
if
away.
they had a clue and they could give you sensitivity analysis, by the way, I'm reflecting on this because this is educational. I'm giving
Yeah,
you feedback the way we're chatting. PPMs often didn't have sensitivity analysis. You
yeah,
would find this stuff in a PPM. And
that's right.
today you don't find this stuff in a PPM. Where do you find them? Pro forma. You can ask sponsor, hey, have you done sensitivity analysis? What if the exit cap rate changes, right? Some of the basic things you can respond to. What if the
Yeah,
rent figures change to this degree, right? These are basic stress tests on a given deal that most sponsors should have given you. So I do concur with the approach that LPs who never looked at the pro forma should be looking, hey,
good.
how sensitive are you to the rents being somewhat below the target? To what degree? So all these lessons learned make a lot of sense. And the interest rate sensitivities, of course, is a big one. This is
Yeah,
can change and break a lot of things. But one thing I wanted to also point out, most people do it the wrong way. If you look when the interest rates were at zero, right? You move the interest rates up. Most people test it, stress test it, just to be, kind of reflecting what I remember. Most deals, people stress test it. You take the Fed funds rate from, 0 to 1/4 up to 2.5.
yeah,
This was thought to be the kind of the upper limit, maybe 3. And the
right.
reason for this, because for the 20 years, the rates were at 0, and the Fed tried to hike, and then they hiked to 2.5, and then they stopped, if you remember, in the previous cycle.
Sure.
So what's really interesting, a lot of these assumptions, you develop the norms, and then what happens, you get a black swan event, and things go way above the norm, and then, of course, things get massively dislocated. But
Yeah,
asking the question is the right question, is how far do you stress? Today, if you wanted to stress test interest rates rising 5%, people are going to look at you. Are you insane? I mean, will Fed ever push the Fed funds rate by 5% from here? What do we need to see? Insane inflation? I don't know. What would it take? But it's kind of interesting how these uh, conversations are relevant, and you're trying to do at least some common sense
yeah,
stress testing.
yeah.
So
2 years ago, we
I
never would have
support the
thought.
idea. Just got to know what is common sense
Yeah,
versus
yeah,
what is extreme conditions.
yeah. I mean, 2 years ago, we never would have thought interest rates would have jumped as high as they did anyway. So, we caught. Are we going to do that again? The chances are pretty low, probably. But again, global economy is pretty mixed up these days. That who knows what'll come out of it. But in my mind, and I coach LPs on this too, of if you're nervous about it, if it's still too risky, that's fine. Now's the time to educate yourself then. Go meet new operators, go get their history, their track record, go learn their process of underwriting and find that next operator that you are going to be comfortable with when deals start coming back around. So now's not a time to sit on the bench and not do anything and wait. Now's the time to educate yourself and go meet new people. Get a part of a community like Passive Pockets or other communities, any community out there, because there's value in having that community experience to vet operators, deals, the economy, whatever, to help educate you to make a better decision on your next deal, whether it's right now or if you want to wait a little while before you get in. Or other asset class. A lot of people jumped into debt over the last couple of years because that seemed much better, was structured better for everybody. It was better than just parking your money in a savings account in most cases. So go learn about debt if you haven't got involved with debt before. Get out. There's other things you can do that has your money working for you rather than just having your money sit and wait until you feel comfortable for the next big deal. I'm not going to try to talk you into, getting out of your comfort zone, but while you're being uncomfortable, go get educated. That's what right now seems to be about to me. I'm out of capital, so I can't invest in anything right now anyway. So I'm going out to meet some more operators that I haven't worked with before. How did they survive through the last couple of years? What are they doing differently? What lessons did they learn? Those are great questions to ask an operator, and that helps vet that operator because if they don't answer those questions to your liking, well, then that's, kind of a red flag to you. So go from there. But it's your own risk tolerance. What are you willing to accept from an operator at that point?
Yeah, great wisdoms. It's funny. A lot of people were in equity, not even realizing that existed when
Right.
equity was a hot topic. And when the equity became a painful topic, then the pendulum swung all the way, and people started running into hard money lending funds and being, lender providing debt capital. And by the
Yeah.
way, still very attractive asset class.
Yeah,
But knowing
absolutely.
both and being able to make decisions to participate potentially in both with your risk tolerance and goals
Yeah,
can be very rewarding. But at the end of
absolutely.
the day, the biggest and best investment you can make is into your own education. So
Yes.
that's why, because working folks who are listening to the podcast, working with Chad would be a great experience, as you hear. Having a coach is important. I've worked with many coaches over the years, and having a good coach can make a big difference in your journey. How would folks reach out, Chad? What's the best way to talk to you? Email, website?
Yeah, so you can track me down on LinkedIn, Chad Ackerman, and I'm a Focal Point Coaching. You'll see there, or I've got a website that is chadackerman.focalpointcoaching.com that you can look me up. Either of those places are the best place to track me down. But hopefully, you come find me. Always happy to help. Love talking about the industry and see what lessons learned I've had as well as I lick my own wounds on some things, but shows we aren't always right. But we learn a lot from our miscues. Hopefully you do anyway.
Well, it's also mindset, right? We only talked about sort of physical learning, right? But the
Yeah,
mindset is the most important thing. Is ultimately fix the mind.
yeah,
Without the mindset, it's very difficult to proceed. And if you can fix how you think about things, take very positive learning experience from any negative experience you have, you could succeed, and that's very important. Any other the advice on a book? So any other book that comes to mind that people know how to find you? Is there a good book that you kind of reading or have read recently that you would recommend?
Biggest book for the industry. I'll tout Brian Burke's book, The Hands-Off Investor. That is so solid. If you are getting into this space as a limited partner, that's a good book to start with to really get an understanding of the underwriting, how to analyze deals and so forth. Brian did a really nice job with what he put together in The Hands-Off Investor.
Thank you, Chad. Appreciate you coming on a podcast. Really enjoyed our conversation, and we'll keep chatting. We intersect enough at these events and conferences, and
That's right.
appreciate your wisdom.
Yeah, no, thank you, Mike. I appreciate the time again. Always a pleasure to get on and talk with you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.